Case study: the 2008 housing crisis background. The 2008 housing crisis was one of the worst financial crises in modern history, triggered by excessive risk-taking in the housing and financial sectors. It led to a global economic downturn, widespread foreclosures, and the collapse of major financial institutions. The crisis was primarily caused by the proliferation of subprime mortgages, risky lending practices, and the bursting of the housing bubble. Key events leading to the crisis expansion phase, early 2000s. Housing boom. Low interest rates and government policies encouraged home ownership. Lenders loosened credit requirements, approving borrowers with poor credit, subprime borrowers. Financial institutions bundled mortgages into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, to sell to investors. Home prices skyrocketed, and many buyers took out adjustable-rate mortgages, ARMs, assuming prices would keep rising. Peak phase 2006, warning signs emerge. The Federal Reserve raised interest rates to combat inflation, making mortgage payments more expensive for those with ARMs. Home price appreciation slowed, making it harder for homeowners to refinance. Many subprime borrowers began defaulting, leading to a rise in foreclosures. Lenders had issued mortgages with little to no verification of income or ability to repay, e.g. ninja loans, no income, no job, no assets. Contraction phase, 2007-2008. Crisis. Unfolds foreclosures surged as borrowers could no longer afford their payments. The value of mortgage-backed securities plummeted, causing losses for banks and investors. Financial institutions such as Lehman Brothers, which was heavily invested in subprime mortgages, collapsed in September 2008. A liquidity crisis emerged as banks became reluctant to lend, fearing further losses. The stock market crashed, and the economy entered a deep recession, with millions losing jobs and homes. Trough phase 2009-2012 recovery efforts. The U.S. government launched the Troubled Asset Relief Program, TARP, bailing out major banks and financial institutions. The Federal Reserve cut interest rates and introduced quantitative easing to stabilize the economy. Programs such as the Home Affordable Modification Program, HAMP, helped struggling homeowners avoid foreclosure. Over time, stricter lending regulations, e.g. the Dodd-Frank Act, were implemented to prevent future crises. Impact of the crisis. On homeowners, millions of Americans lost their homes to foreclosure. Many ended up underwater, owing more on their mortgages than their homes were worth. Credit scores were damaged, limiting future borrowing opportunities. On financial institutions, Lehman Brothers collapsed, while others, AIG, Bear Stearns, Fannie Mae, and Freddie Mac, required government bailouts. Banks tightened lending standards, making it harder for borrowers to get loans. The stock market plunged, wiping out trillions in wealth. On the economy, unemployment surged as businesses cut jobs. Consumer spending and confidence plummeted. A global recession followed, affecting economies worldwide. Lessons learned: stronger lending regulations are necessary. The crisis exposed the dangers of lax lending standards and unregulated financial products. Mortgage borrowers must understand loan terms. Many borrowers didn't realize how risky their loans were, particularly ARMs. Financial institutions need better risk management. Over-reliance on complex financial products led to systemic failure. Government intervention can stabilize markets. Bailouts, stimulus packages, and monetary policies helped prevent a deeper depression. The 2008 housing crisis serves as a cautionary tale of what happens when risky lending, speculative investments, and lack of oversight converge. While the economy has since recovered, the crisis reshaped financial regulations and consumer protections to prevent a repeat. Would you like me to tailor this further for a specific focus, such as the role of government policies or how borrowers were affected? Mortgages and the secondary market explained. When a borrower takes out a mortgage to buy a home, the process doesn't stop with the lender who originated the loan. Mortgages are often sold in the secondary market, where investors buy them as part of larger financial instruments. This system allows lenders to issue more loans while providing investors with a way to earn returns. The primary mortgage market. This is where home loans are initially issued. The key players include borrowers, individuals or businesses who take out mortgage loans to buy property. Lenders, banks, credit unions, mortgage companies, and other institutions that provide mortgage loans. Loan officers and brokers, professionals who help borrowers find and secure mortgage loans. Once a mortgage is issued, the lender can either keep it on their books, holding the risk and earning interest, or sell it in the secondary market to free up capital for more lending. the secondary mortgage market. This is where mortgages are bought and sold between lenders, banks, investors, and government-sponsored enterprises, GSEs. Note: during the crash of 2008, these mortgages that were bundled were sold so many times that in some cases the originators could not be figured out. What a mess. Key participants: government-sponsored enterprises, GSEs. Fannie Mae and Freddie Mac buy mortgages from lenders, package them into securities, and sell them to investors. Private investors, hedge funds, pension funds, and investment banks purchase mortgage-backed securities, MBS. Investment banks: they bundle mortgages into securities and trade them. How it works. A lender issues a mortgage to a borrower. The lender sells the mortgage to a secondary market participant, such as Fannie Mae or Freddie Mac. The mortgage is bundled with other loans into a mortgage-backed security, MBS. Investors buy shares of these MBS, earning returns from the homeowner's mortgage payments. Mortgage-backed securities, MBS. An MBS is a financial product created when multiple mortgages are pooled together and sold to investors. Investors receive payments as borrowers make mortgage payments. Types of MBS: pass-through securities. Investors receive direct payments from the pool of mortgages. Collateralized mortgage obligations, CMOs. These divide mortgage pools into different risk levels, tranches, where some investors get paid first in case of defaults. How the system can fail, as seen in 2008. Lenders issued risky subprime mortgages, loans to borrowers with poor credit. These loans were bundled into MBS and sold to investors who underestimated the risk. When borrowers defaulted, the value of MBS collapsed, triggering the financial crisis. Why the secondary market matters: provides liquidity. Lenders can issue more mortgages by selling existing loans. Standardizes loans. GSEs enforce lending standards to ensure mortgage quality. Gives investors a safe investment option. MBS are usually considered stable investments. However, risky lending and improper risk assessments can cause market crashes, as seen in 2008. Would you like a more detailed breakdown on MBS or how government regulations affect this system? Ginnie Mae, Government National Mortgage Association, does not issue loans directly, but plays a crucial role in the mortgage market by guaranteeing mortgage-backed securities, MBS, composed of government-insured loans. These loans primarily come from programs such as FHA, Federal Housing Administration, VA, Veterans Affairs, and USDA, United States Department of Agriculture loans, which help low to moderate income borrowers, veterans, and rural homebuyers access affordable home financing. Ginnie Mae's guarantee ensures that investors receive timely payments on these securities, even if borrowers default, thereby reducing risk and encouraging investment in the housing market. This system increases liquidity for lenders, allowing them to issue more government-backed loans, ultimately expanding homeownership opportunities for eligible borrowers. A Freddie Mac loan refers to a mortgage that conforms to the lending guidelines set by Freddie Mac. Federal Home Loan Mortgage Corporation, a government-sponsored enterprise, GSE, that purchases mortgages from lenders, bundles them into mortgage-backed securities, MBS, and sells them to investors. Freddie Mac loans, also called conventional conforming loans, must meet specific criteria, such as loan amount limits set by the Federal Housing Finance Agency, FHFA, and borrower creditworthiness standards. By buying mortgages from banks and other lenders, Freddie Mac provides liquidity to the housing market, making it easier for lenders to offer affordable home loans with competitive interest rates. Unlike FHA, VA, or USDA loans, Freddie Mac loans are not directly insured by the government, but they are designed to help moderate to middle-income borrowers achieve homeownership with flexible down payment options and lower mortgage insurance costs compared to government-backed loans. VA, Veterans Affairs, loan provides protection to the lender through a VA loan guarantee. This guarantee means that the U.S. Department of Veterans Affairs will reimburse a portion of the loan if the borrower defaults, reducing the lender's risk. Because of this protection, VA loans do not require a down payment and typically offer more favorable terms, such as lower interest rates and no private mortgage insurance, PMI. However, while the VA guarantees part of the loan, the lender still bears some risk and follows underwriting guidelines to ensure the borrower can repay the loan.